Cryptocurrencies have become one of the most discussed financial phenomena of the 21st century. What began as an experimental technology championed by a niche community has evolved into a multi-trillion-dollar market, drawing interest from institutional investors, tech enthusiasts, and everyday people alike. While the idea of a digital currency might once have sounded like science fiction, Bitcoin's meteoric rise and the subsequent proliferation of hundreds, if not thousands, of new digital assets have shown that cryptocurrencies are here to stay. Today, we'll explore the fundamentals of cryptocurrency investment, with a special focus on Bitcoin and Ethereum, the two most prominent players in the space. By the end, you'll have a clearer view of how these digital assets emerged, what drives their value, and what key considerations prospective investors should keep in mind. The story of cryptocurrency investment begins with Bitcoin. Officially launched in January 2009, Bitcoin was introduced through a white paper published a few months prior by an individual or group under the pseudonym Satoshi Nakamoto. Bitcoin's core innovation was a decentralized digital ledger called the blockchain, enabling secure transactions without relying on a central authority like a bank or government. The ledger, maintained by a network of computers, often called nodes or miners, ensures that every transaction is verified and recorded transparently. Despite its seemingly modest start, Bitcoin quickly gained attention in the technology community. Early adopters saw it as a revolutionary financial experiment, one that introduced the possibility of a trustless, peer-to-peer currency outside the purview of traditional institutions. At first, these adopters traded Bitcoin informally, with stories of individuals buying pizzas or coffee for tens of thousands of BTC, which would later become small fortune. Yet, as more people became intrigued, online exchanges began to facilitate the trading of Bitcoin for real-world currencies like dollars and euros. By 2013, Bitcoin's price began to surge into the hundreds of dollars, and with that surge came broader media attention. Investors started taking notice, asking questions about whether Bitcoin might be a store of value akin to gold or an untested, volatile fad destined to collapse. Skeptics pointed to its price fluctuations and its association with illicit online marketplaces. Meanwhile, supporters celebrated its potential to democratize finance and provide a hedge against inflation or government overreach. While Bitcoin carved out its reputation as digital gold and a pioneering cryptocurrency, Ethereum, launched in 2015, sought to expand the idea of blockchain far beyond just a digital currency. Conceptualized by a young programmer named Vitalik Buterin, Ethereum introduced smart contracts, self-executing agreements coded on the blockchain. This innovation made it possible for decentralized applications, often called dApps, to run on top of Ethereum, effectively creating a platform that could host everything from games and decentralized finance, DeFi, protocols to non-fungible token, NFT, marketplaces. Investors soon realized that Ethereum was not merely a competitor to Bitcoin. Rather, it served a complementary role by broadening the blockchain's utility. Just as Bitcoin had soared in price on market speculation and growing acceptance, Ether, Ethereum's native currency, also began to climb. Developers and entrepreneurs flocked to the network, launching initial coin offerings, ICOs, during the crypto boom of 2017 to 2018. These ICOs raised funds for new projects in exchange for newly minted tokens, many of which were built on Ethereum's ERC-20 standard. While plenty of these projects failed or turned out to be outright scams, the mania underscored a deeper truth. Ethereum's programmability opened the door to a vast array of use cases, from decentralized lending protocols, like Aave or Compound, to NFT platforms, like OpenSea. Over time, Ethereum cemented its place as the second most valuable cryptocurrency by market capitalization, often viewed as the epicenter of decentralized innovation. For investors, this signaled that cryptocurrency was about more than just Bitcoin. There was an entire landscape of tokens and platforms offering different forms of utility and growth potential. It's not enough to acknowledge that Bitcoin and Ethereum exist. To understand the world of crypto investing, one must grasp the diverse reasons why people buy and hold these assets. Generally, investors fall into a handful of overlapping categories. Store of value seekers. Many view Bitcoin as digital gold. In a world where central banks regularly print money and inflationary pressures lurk, Bitcoin's fixed supply, capped at 21 million coins, appeals to those who want a hedge against monetary debasement. For these investors, Bitcoin's volatility might be a feature rather than a bug, offering substantial upside if adoption continues. Speculators and traders. Cryptocurrencies, infamous for their price swing, attract speculators looking to capitalize on short-term moves. Day traders or swing traders exploit technical analysis, market sentiment, and breaking news to buy low and sell high, or short sell high and buy back lower. This group sees crypto as a lucrative but high-risk market, often employing leverage through derivatives. Technological visionaries. Ethereum smart contracts and other emerging blockchain, like Polkadot, Solana, or Cardano, capture the imagination of those who believe decentralized technologies will reshape the internet, commonly referred to as Web3. They invest not solely for monetary gains, but also to support what they perceive as the next paradigm shift, akin to backing internet startups in the early 1990s. Institutional investors. Over the past few years, hedge funds, pension funds, and publicly traded companies have also dipped into crypto. Some purchase Bitcoin as a treasury asset, while others invest in Ethereum-based tokens for exposure to DeFi. The presence of institutional money underscores a broader acceptance of crypto, even if many mainstream funds remain cautious. No discussion of crypto investments would be complete without addressing risk. Cryptocurrencies remain a speculative asset class with significant uncertainty. Newcomers should consider the following. Volatility. Even the largest cryptocurrencies, such as Bitcoin and Ethereum, can see double-digit percentage swings in a single day. Prices are influenced by regulatory announcements, macroeconomic events, or even social media hype. This volatility might present opportunities for quick gains, but can also lead to substantial losses. Regulatory climate. Governments worldwide are still figuring out how to regulate cryptocurrency. Some, like El Salvador, embraced Bitcoin as legal tender. Others, like China, clamped down on crypto activity. In the United States, the SEC and other agencies are debating how to classify digital assets. Are they securities, commodities, or something else entirely? Regulatory shifts can significantly impact crypto prices and usability. Security and custody. Because cryptocurrencies are digital and decentralized, investors must navigate wallet security and private key management. Not your keys, not your coins, is a common refrain in crypto circles, stressing the importance of self-custody if one wants true control over their asset. However, self-custody can be daunting for beginners, who might opt to leave coins on exchanges, exposing themselves to potential hacks or exchange insolvency. Technological risk. Smart contract exploits, protocol vulnerabilities, and network congestion can all pose risk. Ethereum, for example, has faced periods of high gas fees, making transactions expensive. While upgrades like Ethereum's shift to proof-of-stake, known as the merge, aim to address scalability issues, uncertain timelines and potential bugs can still hamper the network. Market manipulation and scams. The relative lack of comprehensive regulation means the crypto space is rife with pump-and-dump schemes, questionable ICOs, and other scams. Investors must conduct thorough due diligence, avoiding projects that promise unrealistic returns. The ease of creating a new token means that not every offering is backed by a sustainable vision or technology. When people talk about investing in crypto, they often focus on Bitcoin or Ethereum. Yet the market now includes thousands of altcoins, each claiming to serve a particular niche, from privacy-focused coins like Monero to stablecoins like Tether, USDT, or USD Coin, USDC. These stablecoins aim to hold a 1:1 peg with a fiat currency, allowing traders to move in and out of volatile positions quickly without converting back to traditional money. Beyond coins, entire ecosystems have emerged around blockchain-based applications. DeFi, decentralized finance, platforms let users lend, borrow, and earn interest on digital assets without intermediary. NFTs, non-fungible tokens, turn digital collectibles and art into tradable tokens, often commanding eye-popping prices. Some investors diversify across these niches, hoping to catch the next wave of growth as the technology matures. However, diversification in crypto isn't the same as diversification in traditional finance. Many coins remain correlated to Bitcoin's price movement, meaning a market downturn can drag down almost all tokens. Nevertheless, exploring different sectors, like DeFi, NFTs, gaming tokens, or Layer 2 scaling solution, can spread risk and potentially capture growth in multiple areas of the crypto economy. For those just entering the crypto arena, the overwhelming choice of assets and platforms can be paralyzing. A few strategic approaches may help. Dollar cost averaging, DCA. Given crypto's volatility, some investors choose to invest fixed amounts on a regular schedule, say weekly or monthly, rather than trying to time the market. Over time, this approach can smooth out the impact of price fluctuation, mitigating the risk of buying high all at once. Focus on blue chips. Bitcoin and Ethereum are often considered the blue chips of the crypto world, established, liquid, and widely recognized. While they're still risky compared to traditional stocks or bonds, they might offer a more stable entry point than smaller altcoins, many of which can be extremely volatile or vanish quickly. Research and community involvement. One hallmark of crypto is the vibrant online communities, Reddit forums, Discord channels, Telegram groups, where enthusiasts discuss new projects, technical updates, and price action. Becoming an active participant, or at least an observant lurker, can help newcomers stay informed. However, one must also exercise caution, as social media chatter can be rife with misinformation or hype-driven speculation. Long-term perspective versus short-term trading. Some investors adopt a buy-and-hold strategy, believing that Bitcoin, Ethereum, and a handful of other projects will gain mainstream acceptance over years or decades. Others trade actively. Neither path is guaranteed to succeed, but it's crucial to understand one's temperament, risk tolerance, and time horizon before plunging in. Security best practices. For those who do decide to hold their coins personally, hardware wallets like Ledger or Trezor offer offline storage of private keys, minimizing hacking risk. Software wallets for mobile or desktop can be convenient, but also more vulnerable if a device is compromised. It's wise to explore how to back up seed phrases securely and stay vigilant against phishing attempts. If one were to zero in on a significant development that shapes crypto investing today, it would be Ethereum's ongoing evolution. Initially, Ethereum, like Bitcoin, used a proof-of-work system for network security, relying on mining. This method has been criticized for its energy consumption, leading Ethereum developers to plan a transition to proof-of-stake, POS, where validators stake Ether rather than mine. This shift, famously termed the merge, finally occurred in September 2022. In theory, POS reduces energy usage dramatically and may improve network scalability over time. While Bitcoin loyalists question POS's security and centralization risk, many see Ethereum's transition as a leap forward that could encourage institutional adoption, given the environmental, social, and governance (ESG) considerations now common among large investors. On top of that, Ethereum's roadmap includes further upgrades, like sharding, to enhance transaction throughput. If successful, these changes could preserve Ethereum's status as the leading smart contract platform while welcoming more complex, decentralized applications. For investors, the technological trajectory of Ethereum provides both excitement and uncertainty, as no major blockchain has completed such an ambitious overhaul at this scale before. Ethereum's smart contract functionality has spurred an entire ecosystem. Two of the most notable trends are DeFi, short for decentralized finance. DeFi replicates traditional financial services, lending, borrowing, trading, asset management, on open blockchain network. Users can deposit crypto into lending pools and earn interest, or trade via automated market makers like Uniswap, all without centralized intermediary. DeFi's growth soared during 2020 to 2021, though it has also witnessed hacks and insolvency. Nonetheless, many believe DeFi represents the future of finance, making it a compelling, if risky, sector for crypto investment. NFTs, non-fungible tokens, convert digital items, art, collectibles, game assets, into unique tokens recorded on the blockchain. While some NFT projects have been dismissed as overhyped or even money grabs, the underlying technology can verify ownership and provenance in a way previously impossible for digital media. Major brands, sports leagues, and artists have begun experimenting with NFTs, hinting at a larger shift in how we think about digital ownership. Ethereum remains the epicenter of NFT activity, though competing blockchains also host NFT projects. Investors in these niches can buy tokens directly, participate in governance. Some DeFi protocols issue governance tokens that allow holders to vote on changes or hold NFTs. Each approach carries its own risk. DeFi protocols might offer attractive yields, but they're also vulnerable to smart contract exploits or liquidity crises. NFTs can be illiquid and heavily influenced by trends, making them speculative assets that can plummet in value if hype fades. The long-term trajectory of Bitcoin, Ethereum, and the broader crypto market will be shaped significantly by regulation. Some governments are adopting a wait-and-see approach, while others roll out comprehensive framework. The European Union's MiCA, Markets in Crypto Assets legislation, for instance, aims to harmonize crypto rules across member states. In the United States, the SEC and the CFTC continue a tug-of-war over whether certain tokens should be treated as securities or commodities. Institutional investors often cite regulatory clarity as a prerequisite for further involvement. If Bitcoin exchange-traded funds, ETFs, become widely available, or if Ethereum-based products gain regulatory acceptance, a new wave of capital could flood the market. Conversely, if stricter regulations hamper decentralized exchanges or stablecoins, the market might face disruption and cooling. Nonetheless, many in the crypto community remain bullish. They note that each crypto market cycle tends to bring new participants, new use cases, and more resilient infrastructure. Even after dramatic crashes, like the one in 2018 or the downturn in 2022, developers continued building, leading to the next wave of innovation. As a result, some believe the industry is on an inevitable path toward mainstream adoption, albeit with bumps along the way. Cryptocurrencies have evolved from a quirky internet experiment to a global asset class in little more than a decade. Bitcoin, once dismissed as a novelty, has been declared legal tender by some nations and is held in significant quantities by institutions. Ethereum, with its smart contracts and vast developer community, has fueled a Cambrian explosion of decentralized applications, DeFi, NFTs, and beyond. Yet, investing in crypto is not for the faint of heart. The market's dramatic rises and falls can test even the most committed believers. Regulatory risks, security challenges, and the sheer number of questionable projects underscore the importance of due diligence. At the same time, innovations like proof-of-stake and Layer 2 scaling solutions promise to tackle long-standing issues of energy use and network congestion, potentially broadening cryptocurrencies' appeal. For those considering a stake in Bitcoin, Ethereum, or the broader crypto universe, the guiding principle is clear. Never invest more than you can afford to lose. Cryptocurrency remains a frontier, and while fortunes have been made, losses have also abounded. A cautious, informed approach, combining a thorough understanding of the technology, community sentiment, and market trends, offers the best chance at navigating this fast-moving terrain successfully. In the end, crypto's allure lies in its dual identity, part risky speculation, part world-changing innovation. Whether you see yourself as a short-term trader, a long-term holder, or a curious observer, there's no doubt that Bitcoin, Ethereum, and other digital assets have expanded our understanding of money and technology. The journey from Bitcoin's genesis to Ethereum's ambitious roadmaps has already reshaped finance and computing, and the story continues to unfold with each new development, protocol, and market cycle.